Hey, Tim Kerley here with your Friday FAQs. Hope you've had a great week. This week's topic is on the subject of recasting as an alternative to bridge financing. You know, in a super low inventory market like we're in right now, the topic of bridge financing comes up quite often. And so I want to stop for just a second and I want to talk about what bridge financing is, and then we'll get into recasting as an alternative. So bridge financing would be where you've got a buyer who wants to buy a new home without selling their current home and thereby avoiding the contingent offer, which I know those are tough these days. But your buyer needs some way to extract the equity out of their old home so they can make the appropriate down payment on the new home and thereby keeping their monthly payments, their permanent monthly payments, in range of where they want them to be. The problem with bridge financing is you just don't have very many vehicles for that at all, short of something like a home equity line of credit. And even then you're limited to the amount of equity that you can pull out of the old home. So an alternative would be a recast on the new loan. So let me explain how this might work. So let's say you've got a buyer that's buying a $300,000 house. They're going to get $60,000 in equity, which would be, they can put down 20% on the new home. So, they would have $60,000 in equity out of their old home. They'll put the 60 down on the new home. Good to go. They don't want to sell their current home, but maybe they have a smaller amount of cash. So instead of doing a 20% down payment on the new home, they could do a 5% down payment on the $300,000 purchase, which would only be $15,000 instead of the 60. Then when they sell this home and they get their equity out of that home, they can make a principal reduction payment on the new loan and have the payments recast, not refinanced, but recast, which basically means the payments are re-amortized based on the new balance of the loan and thereby lowering the monthly payments. So this achieves a lot of things. First of all, you don't have to go through the whole refinance scenario with all the fees and everything. The buyer would, or the borrower in this case, would probably get charged a small fee by the servicer to do the refinance. The other thing is they get to keep their rate, which may be lower than what they would get if they were doing a full refinance anyway. And they don't have to worry with the bridge financing. Now, one caveat is this will only work on conventional loans. None of the government programs will allow you to do it. But it's a great option, and most buyers don't even know that this exists. But again, it's a way for them to be able to make a principal reduction payment later, get their payments re-amortized without having to go through the whole refinance process. All right, hope that's helpful to you. Have a great weekend, and we'll see you soon.